two insurance policies generate exactly the same premium. One creates value and the other one, you guess it, destroys value. And you may ask yourself, why? Because premium isn't the whole story. We've been discussing these concepts here for the last few videos. Some insurance policies consume significantly more capital than others. And if you don't understand capital consumption, you can easily mistake growth for profitability. Today, we are exploring one of the most important concepts in insurance finance. First, hi everyone, welcome back to the channel. My name is Diego, and here we're exploring insurance finance, capital allocation, FP&A, and the strategic decision making. In the last video, we discussed strategic expense allocation, and today we are taking the next step and looking at why certain insurance policies consume more capital than others, and why that matters for profitability, pricing, as well as growth. To begin with, I would like to discuss the common misconception here. What common misconception is that, right? You may ask yourself. All right, let's go. Many people assume that if two policies generate the same premium, they should contribute similarly to profitability. But insurers don't think that way. Because insurers just don't manage revenue. It's not about the revenue. It's about risk, right? So capital is held to support that risk. So the key question becomes, how much capital does the insurer need to hold behind each and every policy? The answer can vary dramatically. Now let's address what drives capital consumption. Well, several factors can influence on how much capital a policy consumes. First, risk severity. Some policies have the potential for very, very large losses. Let's address a few examples on that. Property catastrophe coverage, large commercial claims, natural disaster. Even if claims are infrequent on those fronts, the potential for, large losses are huge, to say the least. A higher potential for large losses require more capital. Second here, volatility. Insurers care about predictability. Stable portfolio may require less capital than highly volatile ones. Two products can generate the same expected profit, but the more volatile product often require more capital support. The third one that I would like to highlight is correlation. This is interesting actually. This is often overlooked. If risks are highly correlated, they tend to go wrong at the same time. For example, if, let's suppose a cyclone may trigger thousands of claims simultaneously. That concentration of risk increases capital requirements, okay? Now, why this matters for pricing? Let's think about pricing for a second here. A policy that consumes more capital should generally generate higher returns, risk return, right? Otherwise, shareholders are not being adequately compensated for the risk being taken. This is where concepts like risk-adjusted return, capital, economic capital, return on capital become critical. Because insurers aren't simply asking, will this policy make money? They are actually asking themselves, will this policy generate sufficient return for the capital it consumes? And that's a completely different question, right? It's like it changes the game. Now, the growth trap. the growth trap. We've been talking about this a little bit here and there. These also explain why growth can destroy ROE. Remember our last video in the series? If an insurer aggressively grows a business line that consumes large amounts of capital, capital grows faster than profits. And when that happens, guess what? ROE falls. This is one of the reasons sophisticated insurers focus on capital efficiency, risk-adjusted profitability, as well as portfolio quality, not just for premium growth, okay? Let's try to address, as I always like to do, a real-world example. Imagine two portfolios here. Portfolio A being a stable personal lines business, predictable claims, and lower volatility, okay? Then we go to the portfolio B, catastrophe-exposed commercial property business, higher volatility as well as larger potential for losses. Both produce the same premium. Same premium. Both produce similar expected profits as well, but the portfolio B may require significantly more capital. That's why insurers often evaluate business performance using capital adjusted metrics rather than premium volume alone. And to close off things here on this video, one of the biggest mistakes in insurance is assuming all premium is equally valuable. It's just simply not that way, okay? Because every policy carries a different capital burden. And understanding capital consumption helps insurers make better decisions about pricing, growth, portfolio strategy, and capital allocation, right? The best insurance companies don't just grow, they grow efficiently, which is completely different. If you enjoyed this video, subscribe, follow the series, and let me know in the comments, do you think your organization measures profitability through a capital lens or primarily through premium and earnings? I'll see you in the next one. Thank you. Cheers. Bye.